we made about $3.5 billion on a $500 million investment, as it turned out. I still sold it way too soon. Since I sold it, they must have shot a gun off and said, Warren sold, now it's time to let it go up.
Well, yeah, you left money on the table.
A lot of money.
Dummy.
So how did Warren Buffett make billions of dollars on a single investment? I know it's really fun to look at and talk about the big money that Buffett's made, but personally, for me, I think it'd be a lot more fun to be able to make those big investments and get those huge percentage returns in my own personal portfolio. So today, I want to take a look at a few big investors, namely Bill Gates and Warren Buffett, and talk about what they do with their investments in order to get these high returns. I do have a full clip from Warren Buffett talking about in that interview how he finds his investments, what he does to look through them, and a clip from Bill Gates. He's a little less attached to the whole process, but as a multi-billionaire, they're still very involved with their money, and obviously they have a way and they have a plan and a strategy that's worked in order to get them the massive wealth that they have today. So today we're going to be looking at a couple of videos of how they do that. But before we get into that, I want to introduce myself and say my name is Chase. Welcome back to Intelligent Money Investing. If you enjoyed this video, please slap the like button, leave a comment down below talking about your feelings about these guys' investment strategies, and let's just get right into it. Here's the Bill Gates clip.
You know, you are an investor who is active in a lot of different arenas. Have you changed the way you look at the markets or changed anything you're doing as an investor based on what we've seen with the Trump rally or based on what we've seen with interest rates to this point?
No, I think the philosophy that Warren Buffett has put forward, that if you can find great companies and invest in them, then the macroeconomics can go up and down, and the basic value of what you're holding on to there will be maintained throughout that. And I have a team of people who manages that for me. They've done a really great job. So we're long-term oriented and don't think that we understand the macroeconomics enough that we're making bets that are specific to that piece.
So as you guys can tell, Bill Gates isn't super detailed on his process. Obviously, Warren Buffett has built his business just on investing. Bill Gates was more involved with Microsoft and building up in that, and kind of more went through a single company. And while Warren Buffett also built his wealth through a single company in Berkshire Hathaway, Berkshire Hathaway has invested in many different businesses, both private and public. So there's a lot more to go into detail with because he has done that in order to build his wealth. Every company he goes into, he evaluates like over and over again, very intricately, and makes sure that it's an absolutely perfect investment that's going to allow him to grow his money over the long run, and that's really worked out well for him so far. Obviously, he's made a few mistakes along the way, but I'm going to let him explain to you guys how he figures out which companies he's going to go into, and he's going to give an example of a company he's made an absolute killing on in the past. So we're going to let him talk, and then I'm going to break down what he says right after that.
We made about $3.5 billion on a $500 million investment, as it turned out. I still sold it way too soon. Since I sold it, they must have shot a gun off and said, Warren sold, now it's time to let it go up.
Well, yeah, you left money on the table.
A lot of money.
Dummy.
That's
what
exactly right.
Charlie Munger would say. Right?
Charlie would say, you've done it again.
But you can't keep always trying. For the average person who's maybe never bought a stock before, what's your advice about that? You can't constantly sit there and wait and say, oh, it's going to go higher, it's going to go higher.
We don't even think about that. What we think about is how much is it selling for, how much do we think it's worth. When we bought it at $35 billion effectively, I felt the company was probably worth at least $100 billion.
How did it come to your attention? How do you find a stock like PetroChina?
I sit there in my office and I read an annual report, which fortunately was in English, and it described a very good company. And told about the oil reserves, told about the refining, told about the chemicals, everything else. And I sat there and read it, and I thought to myself, this company is worth about $100 billion. Now, I didn't look at the price first. I look at the business first and try and figure out what it's worth, because if I look at the price first, I'll get influenced by that. So I look at the company first. I try to value it, and then I look at the price, and if the price is way less than what I've just valued it at, I'm going to buy it.
And how do you value it?
Well, that's the trick. Yeah. But it's essentially what I would pay for the whole business if I could buy it. And when we sold the stock, it was valued, we'll say, at probably 250 to 275 billion. And we thought that was a fair price. Now, oil had gone up from $30 a barrel to $75 a barrel. Now it's up even further. But today, well, yesterday anyway, I believe PetroChina is the second most highly valued company in the world.
Second
higher than
what?
GE, next to Exxon.
ExxonMobil.
Next to Exxon.
Have you sold the entire stake?
Yeah, I have. I wish I hadn't, but I have.
As of when?
Well, we sold it over a period of time.
Sold it over a period of time.
If it went down a lot, we'd buy it back.
Would you ever buy or sell a stock based on political pressure or
No.
sort of? So
No, the answer is no.
People being upset about Darfur had nothing to do with why you sold this stock.
The Chinese government owns 88% of PetroChina. They also own control of 29 out of the 30 largest companies in China. The Chinese government is the one that has a position in relation to the Sudan. And they have it, if you own any one of the 30 largest companies in publicly traded companies in China, you will have the Chinese government as your majority partner. And the question is, are you responsible for their actions?
You're going to China next week for a ribbon-cutting ceremony
Right.
for ISCAR.
Sort of the limit of my abilities, Liz. I mean, that's what they use this.
You're pretty good at cutting a ribbon.
I've gotten used to it, yeah.
Are you looking at other companies in China?
I don't look based. No, the answer is pretty much no. But I don't look based on countries or that sort of thing. I just read every report I can, and I try and figure out whether something is cheap.
But how would you find a report like PetroChina 4 years ago? This was not a name that maybe that a lot of people would.
Other guys read Playboy. Yeah, I read annual reports.
Now, I think one of the really important things that Buffett says here is that a quote along the lines of, some other guys read Playboy, I read a lot of annual reports. So in that, he's really telling us how devoted he is to reading and how that's really his number one passion. And that's absolutely what it has to be if you're your avenue to make a lot of money. It's really got to be something you're passionate about, something you want to do in your spare time, and something that you're going to go through excruciating detail in order to put your money behind. And that's why I advise a lot of people to buy into Berkshire stock, because that's one of my biggest investments personally, and also look at the companies that Buffett is buying now and decide if those are in your parameters that you want to pursue further. Obviously, we can cheat off some of his work by going and seeing the filings that he puts in, but that's not nearly enough to what you want to do completely, just because you want to be able to do your own due diligence, have your own conviction about buying, so you don't just sell off the first time there's a dip. You want to research and be confident enough in a stock that if there's a dip, you want to buy more and you're excited for a lower buying opportunity, and that you know the financials well enough to know the company is going to be great off in the long run, even if their stock price goes down a little bit. So Warren Buffett's basic principles are essentially to read absolutely everything he can. I believe he goes into the office and spends most of his day reading about different companies, different annual reports, different financials of companies, and that allows him to have a really major competitive edge because of that knowledge he has from spending his entire day reading and looking at the numbers, when other people might spend the day just looking at the price or the price fluctuations and not actually spending their time looking at how this company is actually performing, how their revenue is growing, how their profits growing, if it's sustainable, if their company is very protected and has a good moat, and all these other factors. So I hope you guys enjoyed this video. Please drop a like and comment if you did. I definitely want to hear from you guys. I read and respond to pretty much every comment that comes in down below. So definitely do that if you haven't already. And subscribe, ring that notification bell, and I will see you guys in the next one. Thanks so much for watching.
Some of you might say, yeah, but Tony, the market's really frothy right now. I hear we keep breaking records. On average, we break a record once a month. Now, sometimes it goes 7 days in a row, but that's the average. And here's the other thing. There was great research done by JP Morgan, and they found something interesting. If you're trying to time the market, forget it. Warren Buffett told me, he said, the only reason you have these forecasters, market forecasters on CNBC is to make fortune tellers look good, because nobody does it successfully. But what he also taught me was, if you're going to be successful, you got to understand that if you're out of the market, that's the most dangerous thing you could be, even if you have a small amount of money. I said, how could that be? Because if you miss the 10 best trading days of the last 20 years, instead of having an 8.2% return, which means you double your money every 9 years, which is what most people did if they're in the index, the S&P 500, I'm talking in shorthand. But if you just miss the 10 top trading days in 20 years, your return's 4.5% cut in half. If you miss the top 20 days, you make 2%. You might as well have a bond. If you miss the top 30 days because you think you're trying to time the market, you think it's not a good time, then you lose money. In the same exact market. So you got to be in the market. You say, but what if I get in tomorrow and then it crashes? Great. JP Morgan did a study on that also. So did Charles Schwab independently. Guess what they found out? They took one group and said, this person is going to get in on the best day. It's Miss Genius. Somehow the market crashed. She got in on the worst day and it went straight up. So she's going to do well. Second person, they got on the worst day, Mr. Idiot. The day the market hit its peak, they got in the next day it crashed. Third person is called dollar cost averaging. They invest the same amount every month, no matter what the prices are, and that averages it out. And the fourth person says, I'm staying out of this thing. It's too scary. I'm going to be in cash. And then they look at where are they 20 years later. Well, you know who's worse off. The cash person has no money, right? Who's best off? The person with the best timing. But here's what's amazing. The person who got in on the worst day, if they stayed in the market and they're there for 20 years, they only have $14,000 less after 20 years than the person on the best day. So the most dangerous thing to do is not to be an owner, to not be in the market. If you stay in the market and you don't sell, the market takes nothing from you. And if you look at history, in American history, 2.5 centuries, it could change, but for 2.5 centuries, through World War I, World War II, recessions, depressions, overseas challenges, Brexit, we've all been able to continue to grow. You don't want to bet against the United States, you want to be in it.